In this session, I will show you the problem of using the PE multiple and why you should avoid it. To illustrate this problem, I will also discuss ROE, return on equity. So the PE multiple is the trading price per share divided by the earnings per share. And if we take the trading price per share and we multiply it by all of the shares outstanding, we will get the market value of equity. And if we take the earnings per share and we multiply it by all of the shares outstanding, we get net income. So another way of calculating the price to earnings multiple is to take the market value of equity divided by net income. And another way of saying market value of equity, and what finance professionals usually refer to this, is market capitalization. Now, I want to show you something interesting. Return on equity. Return on equity is net income divided by the market value of equity. And remember, whenever we calculate multiples and returns, we look at the market value of equity. And the return of equity is usually a percentage. What happens when we inverse the ROE? To do that, we take 1 divided by ROE, and 1 divided by a percentage usually gives us a multiple. And so it inverses, and we get market value divided by net income, which is another way of saying PE multiple. So as you can see, the PE multiple is the inverse of the return on equity formula. But ROE is very problematic. And if ROE is problematic, then the PE multiple becomes problematic. Let me illustrate in this example. In this scenario, we have two identical companies in terms of revenue and operating profits. The only difference between these two companies is its capital structure. This company has 100% equity financing, whereas this company has 50% debt and 50% equity financing. As a result, this company has to pay interest of $300. However, the tax authority allows interest expense to be deductible when you calculate taxable income. So hence, there's a $120 tax saving, as you can see here. When we calculate ROE in this example, we see that the second company looks more attractive as it has a higher ROE. But this is solely because of its debt. We're taking net profit divided by equity of $5,000, whereas in this example, you're taking net profit divided by equity, which is much larger. And so ROE for the company with debt looks way more attractive, even though at the operational level, both companies are the same. For this reason, investors, in particular M&A investors, especially private equity investors, prefer to look at ROIC, return on invested capital, when analyzing companies. Let me talk you through ROIC. What is ROIC? Invested capital includes equity, debt, preferred shares, etc. But for this lesson, I will focus on the main sources of capital, which is equity and debt. Equity holders have claims to the earnings after everyone else has been paid. So once you've paid everyone, once you've given everyone their share, what's left in the box is due to equity holders. So the very end of the income statement, which is net income attributable to equity holders, is what's due to shareholders. Debt holders are only due their contractual interest payments. What you agree upfront to pay them in interest and the repayment of capital and nothing more. No upside in profits. If the business does really well, debt holders get no upside. So we can construct the ROIC formula as follows. Net income is due to equity holders, and remember we always use market value of equity when calculating returns and multiples. And interest is due to the debt holder. But remember we said interest is tax deductible, So the true cost of the debt to the company is actually lower. Therefore, we put interest after tax. Net income plus interest after tax gives you EBIT after tax, or what we call no PAT. And the market value of debt and plus the market value of equity gives you the enterprise value. So this is the ROIC formula that you typically see in textbooks. Over here, I've just broken it down to make it easier to visualize. And similar to when we inverse ROE to get the PE multiple, if we inverse ROIC, we get the EV/EBIT multiple, which many of you may have heard about. So let me explain the problem of ROE and then show you how ROIC solves this problem. As illustrated, ROE is distorted by capital structure. However, ROIC shows a return which is not impacted by capital structure. In this case, the ROIC for both companies here is 10%, and it makes sense because they have identical operations. Let's quickly see how they calculated it. Net profit plus interest after tax gives you no PAT divided by debt plus equity, and it gives you 10%. Net profit plus interest after tax gives you no PAT divided by debt plus equity gives you 10%. As you can see, ROIC is not impacted by capital structure. As mentioned earlier, the inverse of ROIC is the EV/EBIT multiple, and the inverse of ROE is the PE multiple. The EV/EBIT multiple is what we call an enterprise value multiple, and the PE multiple is what we call an equity value multiple. In the next session, we will delve deeper into enterprise value multiples and equity value multiples.